Ladies and gentlemen, it is a great pleasure for me to be presenting again at this year's Euromoney ECBC Congress. Unfortunately, again, not in Barcelona, but hey, we're all getting used to these virtual formats. Now, markets are clearly preoccupied right now with the question, what will happen with QE? How will the ECB exit the pandemic emergency purchase program next year? But equally important, and well, certainly for banks, is the question, what will happen with ECB borrowing? What will happen to the TLTROs, the 3-year borrowing operations that the ECB is offering to banks? Now, maybe taking one step back, remember it was 10 years ago, in December 2011, when the first 3-year LTROs were announced by the ECB, and well, the rules were a lot simpler at the time, but still for those who struggle to understand what is really happening, this gentleman here, Mr. Sarkozy, the French president at the time, explained it in very simple words. Well, these operations, they mean that each state can turn to its banks, which will have liquidity at their disposal. So this basically meant that the Sarko trade was born and banks engaged in carry trades, borrowing at very low rates from the ECB and investing at much higher yields at the time in their sovereign bond markets. So 10 years on, we've had the 3-year LTRO operations, which were then followed by the targeted LTRO operations, the TLTROs, TLTRO 1, TLTRO 2, and now we have TLTRO 3, which has by now actually brought banks' borrowings from the ECB to levels above 2 trillion. So in this keynote today, I would like to address the following 2 questions. First, on the TLTRO rules, where do we stand, and importantly, what is expected in terms of recalibration for next year? And second of all, what does this mean for flows, for borrowings from the ECB, or also the important excess liquidity that the ECB injects via these operations into the markets? So here's the state of play. This is where we stand right now with what has been announced already by the ECB. Actually, this month we will get TLTRO 3.9, so the 9th tranche of this TLTRO series, which will be allotted later this month. Another tranche has already been decided for December, TLTRO 3.10, but this would be the last one according to current announcements. The first voluntary repayments for TLTROs, or for these TLTRO 3s, will then actually also be possible at the end of this month. The additional special interest period, the -1% that banks can achieve when borrowing from the ECB, runs from June this year to June 2022. And the benchmark, the lending benchmark that banks need to achieve to get the -1% is from actually the end of September 2022 to the end of this year. So banks have to show positive net lending to achieve the -1%. Collateral, here keep in mind that easing measures are still in place, but they are expected to expire also in June next year. Now, so much the easy part. recapitulating what the rules are. But now, what is expected for next year? Now, here are our calls for the recalibration that we should get. A new series of quarterly 3-year TLTROs should be announced in December. I think with this, these operations will become quasi-permanent. Banks can probably rely on the ECB to continue extending these 3-year operations a lot further, also to avoid cliff effects. And so at least through the end of next year, new quarterly operations should be announced by December. Probably the most important question for bank treasurers concerns the one on the special interest period. And we think it will not get extended this time around. It is quite contentious, and so more likely than not, the ECB will not extend the -1% once again. To compensate banks, though, for the cost that they have due to the negative interest rates from the ECB, we can well imagine that the tiering multiplier will be adjusted, so the amount of reserves that banks can hold at 0 and don't have to pay the penalty rate of -50. And we can well imagine that this multiplier could even be doubled under what would be a rules-based adjustment to the tiering multiplier. Collateral, clearly here a lot of options exist. Quite likely the ECB should at least get rid of some of the pandemic emergency measures that were introduced last year, like the grandfathering of bonds that got downgraded during the pandemic. But more likely than not, it will still rely on a lot of discretion that national central banks have in allowing credit claims as collateral. And here the easing measures that were decided could potentially get extended, but remain at the risk of the NCBs, the national central banks. Now, admittedly, these rule changes are subject to quite some uncertainty. And this simply has to do with the fact that depending on how the ECB recalibrates parameters like especially the special interest rate period or the tiering multiplier, there will be winners and there will be losers. And in this chart, I've tried to sketch the current state of play as to who benefits the most from the -1% on the other hand and the depot penalty on the other hand, and who is at most disadvantaged. And well, as you can see here, especially banks from the periphery are the main beneficiaries. This has to do with the simple fact that relatively they have more TLTRO borrowing, so they get to enjoy more of the -1% interest rate subsidy via the TLTROs compared to the excess liquidity that they have, basically, where they have to pay the -50 basis point depot penalty. And core banks, on the other hand, have relatively less TLTRO borrowings, but at the end of each day, they are left with more excess liquidity, which still keeps mainly flowing to the northern countries so that they are subject more to the depot penalty than the periphery banks. So I think this already illustrates the political dimension behind any recalibration and why there may also be compromises along different lines than the ones that I have sketched before. Now, so much about the TLTRO rules. Now, let's have a look at what does all of this mean for money flows, for borrowing or repayments and excess liquidity. Now, starting with the repayments, which are for the first time possible actually under TLTRO 3 at the end of this month, what you see here is the state of play as to who is meeting their benchmark of increasing net lending relative to the end of 2022. So these are loans to corporates and households, excluding for house purchases. And as you can see here, banks in France and Germany look relatively comfortable with the latest data from July this year in having increased their lending versus September 2022, whilst banks in the periphery from Spain and Italy still need to increase their net lending to get to 0%. Now, having said this picture may look comfortable for France and Germany, but there are some caveats. First of all, there's a very strong seasonal impact on lending towards the end of this year. So each year in December, banks usually experience a decline in net lending due to balance sheet steering reasons. So therefore, banks probably require a positive number as we run into the end of this year, or a positive increase of their net lending books. And second of all, this is a very rough comparison of the available data that we have, which is according to countries. But of course, this may look very different bank by bank within these countries. So the bottom line now on repayments here should be that for September, there really shouldn't be a whole lot of repayments, because by September, a lot of banks won't know whether they really meet their benchmark, whether they really can qualify for the -1% special interest rate period. But by December, we need to take another close look at really where individual banks or countries are, and quite likely there could be some banks who will decide, well, we're not going to get the -1%, so one of the major incentives for us to be in TLTRO 3 is gone, and therefore they may decide therefore to repay part of their funding in December. Now, let's have a look at the TLTRO borrowings for next year and what this can do to the excess liquidity. Now, this chart shows the pattern of excess liquidity and our expectations going forward. Let me explain. This dark blue line shows the amount of excess liquidity from banks held at the ECB that is subject to the -50 deposit penalty rate. And as you can see, in late 2019, when the ECB introduced tiering, a lot of this excess liquidity became exempt, so did not have to pay the -50, but actually was able to enjoy 0%. And so the dark blue line dropped. Importantly, since then, it has been rising, and quite steeply so, to levels where by now the amount of excess liquidity held at the ECB is about twice as high than it was at the time when the ECB introduced tiering. Now, the light blue line illustrates how we expect this excess liquidity to develop going forward. And what you can see first, a further steep increase, as we still expect some TLTRO borrowing, but more importantly, the QE program to continue. But then in June next year, under our assumption that the special interest period will not get extended, we should get a significant slump in excess liquidity in ECB TLTRO borrowing from the ECB, simply because banks repay as the incentive of the -1% vanishes. Now, this chart already illustrates that the ECB should contemplate adjusting the tiering multiplier, because right now as I said, the amount of excess liquidity subject to the depot penalty is twice as high than it was at the introduction of tiering. Now, this yellow line here illustrates the proposal that Mr. Villeroy from the ECB has actually made, where the multiplier should be adjusted according to a specified rule. And in simple terms, this would mean that banks will not have to pay the -50 on the excess liquidity, which is not their fault, namely the excess liquidity created via QE. And so you can see that right now already, the pain from banks from the negative interest rate, the -50, would be a lot lower. And if this tiering, this rules-based tiering is being introduced, say sometime next year, we could get back to levels where excess liquidity will then actually be at levels similar to where it was at the introduction of tiering. So let me sum up what are the main views now going forward for TLTROs and liquidity. First of all, yes, we do expect another round of TLTROs to be announced by December, which should then affirm a quasi-permanent 3-year ECB funding, which will probably be available a lot longer than the end of next year. The parameters should be recalibrated though, and most importantly, we think that a shift away from the TLTRO subsidy towards more tiering relief should be sensible. Liquidity conditions clearly will become more volatile. Keep in mind that banks can now repay TLTRO money starting this month. And most importantly, there is downside risk to the ECB balance sheet in June next year, because this is the time when the special interest period, the -1%, will expire. And if it does not get extended, then clearly a lot of banks will simply choose to repay ECB borrowing to a larger degree. We can imagine close to 1 trillion in this scenario could get repaid. For banks, this means that funding risks are still relatively muted though, because keep in mind that a lot of banks, regardless what the ECB Bank Lending Survey says, a lot of banks are certainly in TLTRO 3 because of the -1%, which at the same time they're depositing at the ECB for -50. So the deposit TLTRO carry trade is a clear motivation for banks to be holding these TLTROs, and therefore they can repay their TLTRO borrowing simply by drawing down the asset side of their balance sheet, namely the deposit holdings at the ECB. P&L, however, will be impacted because the -1% will be gone, and therefore depending on what the new TLTRO rate will be, and certainly how much excess liquidity you have, and what will happen with the tiering multiplier, this will have a clear impact on bank P&Ls. Last not least, in terms of the market implications, for money markets, clearly there is upside risk to Euribor spreads, the so-called FRA-OIS spreads, because this huge surge in excess liquidity in the wake of QE and TLTRO borrowings last year was responsible for depressing these spreads. So these should normalize to positive levels then sometime next year. In terms of bank funding spreads, clearly the P&L impact from the recalibration may lead to some spread movements, but as said, the pure funding impact should not be so large because TLTROs will still be around. It's just a question as to how attractive they are in terms of the interest rate subsidy. Now, this concludes my thoughts on what to expect from ECB TLTROs and how banks should be dealing with it. I hope I was able to lift a little bit the fog surrounding these operations. And as always, slides are available upon request. And I now would like to wish you more inspiring and interesting sessions and workshops throughout this Congress. Thank you very much.